In this video, we're going to talk about how review-level financial statements can help you get and keep your business loans. The first thing I want to talk about when it comes to review-level financial statements and the business loans that you're trying to obtain is assurance and credibility. Assurance is the level of service that the accountant performs. So in a review-level financial statement, the CPA is performing a limited amount of the CPA is providing a limited assurance that the financial statements are free of material misstatement. And that's different than an audit, where an audit says that the opinion that the CPA issues says that the financial statements are free of material misstatement. So there's a big distinction there. However, most banks are not looking for audit-level financial statements. They're looking for review-level financial statements. And this brings us to the next point, which is credibility. Credibility is the reputation of the accounting firm and the accounting industry in general that is held by performing the same services that all accounting firms are going to perform across the board in order to issue a review-level financial statement. So when you go to a bank and you have a review-level financial statement in hand and you say, hey bank, I would like to borrow money, they know that you have performed a high level of service and that you're prepared and you're serious about getting this loan. Whereas if you showed up with maybe just an internal financial statement or a spreadsheet of some sort, while they would take you seriously, it doesn't hold the same weight because the CPA's reputation is not behind those financial statements. Because of that, a review-level financial statement will often help facilitate the process of borrowing money from a bank. So what kind of money would you need to borrow? Well, a lot of times our clients are going to banks for lines of credit or term loans or equipment financing. And when there's collateral like in equipment, it's a little bit easier. But when you're just trying to borrow money against your receivables or your future cash flow, a financial statement is going to be very important to have in hand when you apply for that loan at the bank. So what are lenders looking for when you provide them with a financial statement? And what are they looking for in this application that you make when you're trying to obtain financing? Well, number one, you're going to fill out an application for the loan. And it's going to ask you about what does the business do and how does it perform and what debt does it have already and what does it own? Well, all that's already spelled out in the financial statements that we would prepare for you. But you're filling out an application and then the accounting firm is providing a financial statement. And now the bank is going to compare those two things, right? So they'll see if there's liabilities on the financial statement that weren't listed in the application. So they're corroborating information by doing it this way. And it provides them a level of comfort. If your company is able to service the loan, the financial statement will provide that assurance. So it'll provide that comfort that the bank needs in order to see that you're profitable enough to make the debt service payments, to pay off the loan within the terms of the loan. And there's often other times the banks will be looking for, they want to make sure you're not going out and borrowing extra money on top of the money that they've borrowed. So they'll set certain ratios that you have to meet, meaning your cash has to be equal to the amount of debt that you have at the end of the year, or something along those lines, where if you've depleted all of your cash and you've gone out and borrowed a whole lot more money, well, the bank is going to they're going to start asking questions. The financial statement that you're going to issue, which will likely be on an annual basis, is going to disclose that information to the bank. So it's very important to sort of stay within the parameters of your, of the loan document that you have with the bank, and also for the accounting firm to be able to see what that is and then advise you on, where are you going to be with regard to certain restrictions and covenants that may be in those loan documents. I have a client and they're a relatively new company and they've gone out and they obtained a line of credit with a big bank. And then they asked that bank for an additional amount of line of credit. They would like additional borrowing power. And the bank said, well, you haven't been in operations for more than 2 years or more than 3 years. And the amount that you're asking for is going to trip our underwriting requirements. And you're going to need to issue a review-level financial statement. So if we were to issue a review-level financial statement, this company would then be able to go out and borrow additional money and fund their operations and be more successful than if they weren't able to borrow money. So in this instance, the client needed to go out and they needed to obtain a review level financial statement, which is a limited assurance on their financial statements in order for the bank to feel comfortable loaning them an additional amount of money over and above what they already have. So if you're trying to borrow additional money, or maybe are running into roadblocks with the bank because you're only providing them with tax returns or internal use financial statements, maybe a review level financial statement is the right choice. And if you're interested in talking to us about it, we're happy to help.